You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 8th of April 2025 and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Next, Gamma Communications, Fevertree, Aptitude Software, G Barr, and our US company of the week is Nike. John, do you want to start us off with Next, a business that continues to perform?
Yeah, no, absolutely. So Next, it's one of the UK's biggest retailers, and it's branded itself in recent years as more of a hybrid kind of clothes retailer. Anyway, they had their full year results out with full year sales growing by 8.2% to £6.3 billion. And within that, the UK online sales grew by 5%, more than offsetting a small decline in the retail stores. Overseas sales grew at a much faster pace of 27% to around £900 million. And underlying pre-tax profit rose by 10.1% to just over £1 billion, helped by an uplift in full sale prices. Free cash flow was broadly flat at around £1 billion, and net debt, including lease liabilities, rose 3.8% to £1.7 billion. Trading over the first 8 weeks of the year was ahead of group expectations, and the group's now expecting full-year sales growth of 5%. And full-year pre-tax profit guidance has been upgraded by £20 million to £1.07 billion. A final dividend of 158 pence a share has been announced, bringing the year's total to 233 pence a share, which is up 12.1%, and the share buybacks for the year totaled £360 million, and shares were up nearly 7% in early trading. In terms of valuation, Next has a market cap of £12.8 billion and trades at 14.4 times forward earnings, compared with a 10-year average of 13.7, and it has a prospective dividend yield of 2.5%. I thought these results were really good. I think it does reinforce Next as probably the highest quality retailer in the UK, and they've got an excellent online and hybrid platform which other retailers, particularly clothes retailers, also make use of. I think the difficulty with the investment case for Next now is almost that it's been so successful in the UK, and whilst it's still putting up these numbers, you do feel, a bit like when we talk about Greggs, that it's kind of reaching saturation point in the UK. And I know they did have some really positive figures from abroad, but they're still much, much more modest compared with, the core UK business. And we've seen retailers, I suppose, trying to go and crack that US market, and most of them failing. And where does that future growth come from for Next? I guess that would be what would stop me from probably buying shares in Next. Although I guess you would argue that at 14 times forward earnings, it's not hugely expensive anyway, so it's not necessarily really baked into that price. But I think that's probably why I wouldn't be buying shares in Next. I know we've covered it now for about 5 years, and I do regret probably 5 years ago when we saw all of the positivity from Next, and it was a fair bit smaller then, not buying then. But now I'm not confident for those, that next step of growth. Sam, what are your thoughts on these results and Next?
The results are outstanding. I don't understand how it keeps doing this. Is it just... I mean, that international figure is fantastic. I know it's still a small part of the business. What is it? 1 billion or 900 million compared to 6.3 billion in the UK. I wouldn't have thought it would be the kind of business that would translate so well overseas. And that's what concerns me, because I've had a look and it's like, so some of that overseas revenue, it comes from, for example, some of it's coming from India and America. And in America, they've got Nordstrom, which is one of the big stores selling Next products. So they are basically just selling it to Nordstrom like a wholesaler. And then the Indian one, it's a bit different because it looks like it's more of a franchise. It's just not a business I would have expected to scale so well. And that's my concern. If I was to buy it now, even though the valuation is pretty reasonable, it's got to continue to scale in those markets. So yeah, like you, I'd be uncomfortable, but I just wouldn't bet against it because it's just such a fantastic operator. I don't think I think it is by far and away the best British retailer in terms of how it's run, at least. It's just to put up these. I mean, if they can keep doing it, it's just phenomenal, really. What's the market cap now?
It is £12.8 billion.
It does have to keep putting up the numbers overseas. That's the issue.
Mm.
And that would concern me. But they are such a strong operator, I wouldn't put it past them. But I wouldn't buy it.
What about Gamma then? That's from a previous portfolio.
Yes, so it's a business I used to own, but then sold it because I don't really understand it. And for anyone who is not already familiar with Gamma, they are a leading provider of technology-based communication services across Europe. So a lot of it's like business-to-business technology that allows usually communication stuff for businesses. So if you've got like a work phone, for example, a lot of time Gamma's technology will sit in the background in that. So they have come out with full year results, and revenue was up 11% to 579 million. Gross profit was up 12% to 300 million. Gross margin was up from 51 to 52%. Adjusted EBITDA was up 10% to 125 million. Profit before tax was up 34% to 95 million. Adjusted profit before tax was up 14% to 111 million. Adjusted earnings per share was up 31% to 72p. Total dividend per share was up 14% to 19.5p. Cash generated by operations was down 5% to 116 million, and the adjusted cash conversion was down from 108 to 96%, and the net cash position improved by 14% to 153 million. They completed 3 acquisitions during 2024, with each enhancing future organic growth: Coolwave in February, BrightCloud in July, and Placetel in September. They also acquired Starface in February 2025, which was after the year end, which they've said positions them as a leader in the German SME cloud communications market when combined with their acquisition of Placetel. The German market is both larger and has materially lower cloud penetration than the UK. In Germany, they now have over 500,000 cloud seats along a range of products to meet growing customer communication needs. They have announced as well that they're moving to the main market, so that would put them on the FTSE 250. And they expect that to be done by 2nd of May 2025. They also announced a £50 million share buyback in the first half of 2025. And they've said the reduction in the cash conversion was due to non-repeatable working capital improvements in the prior year. Recurring revenue grew to 516 million, and that remains 89% of revenue. And for 2025, they said trading has begun well with good progress in Europe, particularly in Germany, as they continue to integrate their recent acquisitions. They expect satisfactory group organic growth supported by continued active cost management throughout the year. They expect this to be further strengthened by the recent German acquisitions, driving strong group growth. In terms of the valuation, the business trades at PE ratio of 14.5, has a dividend yield of 1.6%, and has a market cap of 1.15 billion. I really struggled to see why, because the shares are actually, they've not done, I don't know if it's just a general market, so it kind of distorts things really when you look at these kind of results now, given what's going on in the wider market. But they're down 12% over the past year, 12% over the past 3 years, and then they're flat over 5 years. But I just think the P's updated, since I prepared this. It's now at a P of 13.8. But I think these are an excellent set of results. They're continuing to reinvest their earnings into further earnings enhancing acquisitions. The expansion into Europe's going really well. The only negative I can find is that if they're buying back shares now, that maybe suggests that the acquisition opportunities aren't as good as they maybe were. But then if they did 3 acquisitions last year and they've already done 1 in this year, that might not even be the case. But yeah, for a business putting up these kind of figures with that kind of track record to be at a PE of under 14, I do find it odd. I can't see an obvious reason for it to be that cheap, other than kind of just what's going on in the wider market. But yeah, I think they're an excellent set of results. What do you think, John?
Yeah, I mean, certainly on the surface, they look excellent. I think difficulty for me is, as you alluded to earlier, is understanding this business. It seems very technical and not knowledge that I have, but I think it certainly could be an interesting investment.
Yeah, that's why I wouldn't buy the shares back. I think someone who understood the business could do very, very well on the surface because it looks like a really well-run company.
And what made you go for it in the first place?
really what we're seeing now, actually, because when I originally bought it, it wasn't doing the European expansion, but I think it wasn't quite as saturated in the UK. But it was the same. It was doing the same thing. It was just reinvesting those earnings into acquisitions that basically immediately enhanced earnings, and it was quite an attractive valuation, I thought, for the historic growth as well. And it just looked like a good little business. The problem is I just never really fully got a handle on how the technology works.
Sure.
Because it's the kind of technology that always sits in the background as well. Even if you do use it, a lot of the time you don't know you're using it. So it just becomes a lot harder to visualize.
Fine.
Right. Shall we move on then to Fevertree? Company that I own, but I don't think you do.
No, that's right. I think I've been close a couple of times with Fevertree. It's one we've covered on the show a few times before. It most famously makes a Fevertree tonic water and also has a variety of other soft drinks. They have their full year results out, with full year revenue growing to £368.5 million, with 367.9 expected, which is up 3%, ignoring the impact of exchange rates. This was driven by double-digit growth in the US and the rest of the world, which helped to offset declines in the UK. Underlying cash profits, EBITDA, rose 66% to £50.7 million, driven by lower glass and freight costs. Free cash flow improved from an outflow of £6.4 million to an inflow of £66.9 million due to improved profitability, and net cash improved 60% to £96 million at the year end. The 2025 outlook has been reiterated, with revenue expected to grow at low single-digit rate. Underlying cash profit margins are expected to be around 12%. A final dividend of 11.12 pence per share has been announced, taking the full year total up to 16.97 pence per share, which is up 2%. And the current share buyback programme has extended by £29 million, resulting in up to £100 million of shareholder returns over 2025. And the shares were up 5% in early trading. In terms of valuation, the group has a market cap of £941 million and trades at 29 times forward earnings, compared with a 10-year average of 44, and there's a prospective dividend yield of 2.3%. I thought these results were pretty good, and I know the focus for Fevertree over the last few years has really been cracking the US. It seems to be doing a very good job there, and as we've mentioned before, it's got a partnership with Coors now, which is the second largest brewer in the States, and it has access to their production, distribution, and customer network, which I think is going to be really important in continuing to improve market share in the States. In terms of the valuation, I think by historic standards, it's certainly reasonable. It still looks like it's more on the expensive side, but I guess if you have that upside and if it can continue to perform in the States, then that soon comes down and it could look very cheap. I think also it's worth saying that it does have a very strong premium brand, and I think you do think, or historically associated a bit just with kind of gin and tonic, but it's expanded a lot and it has a wide range of drinks which are all actually doing pretty well in their own right. Sam, what are your thoughts on Fevertree and these results?
Pretty similar. I think the results are decent. I think the rise in the cash profits is good to see, although I think we'd both thought at the time when the glass costs were going up, it didn't seem like something that was going to stick around forever, so it's not unsurprising. As a shareholder, I'm happy with it. The only thing is, I've had another look at the agreement with Molson Coors. So sort of tucked away in the detail, although I probably should have picked it up the first time, but they've actually sold the US entity. It is effectively what we said, but instead of them actually doing any of the US stuff, they've sold the US entity, and they're basically getting like a royalty for everything that's sold in the US.
Oh, interesting.
So it's more similar, probably to like a Coca-Cola model, actually, in terms of the relationship that has with like Coca-Cola Hellenic or Coca-Cola FEMSA, which I think is quite interesting because a lot of those risks of going overseas are now kind of removed in terms of when we look at other UK companies that have tried and failed. A lot of those risks have kind of been taken out of the equation. The only thing is they are still required, as you can see, to contribute to stuff like the marketing spend. My main issue as a shareholder is I would love to know what the royalty figure is, or the percentage.
Yeah.
Because that makes a huge difference as to how good a deal they've gotten. Now, I expect, given how well the US business was doing, I'd hope they've driven a pretty hard bargain, especially given that it is quite a small acquisition for Molson Coors. So I'd hope they've been able to drive a decent bargain, but there is a bit more of an unknown than I thought, in that you don't actually know what royalty they've negotiated, but just have to kind of trust that it's pretty decent. But yeah, so that does add an element of unknown. But I think in terms of, obviously, if they can crack that, and I think to be able to piggyback off of, well, not even piggyback, to have Molson Coors doing basically everything really in terms of the distribution and the sales and stuff like that. I think to be able to leverage their network in full, and I think in fairness, this deal is the only kind of deal that would have allowed them to leverage the network in full. I think it does give them a real opportunity to go out and properly crack the US. And they have made the point as well that although the earnings that will come through now will be much higher quality. I know they're ramping up the marketing at the moment to try and basically grow the market. But if they get to a point where the market is as saturated as it is in the UK, and they don't have to spend quite the same amount on marketing, the earnings that would be coming through would be incredibly high quality.
Yeah. So you're a happy shareholder then?
I'm happy, but I think there is just that element of uncertainty. It would be nice to know what the royalty percentage that was agreed was, but I suppose if you give it a couple of years, you'll soon find out whether they made a good deal or not, because you'll see what earnings are actually flowing through. But it's a bit more of a gamble than if you could see the royalty figure and say, well, I think they're going to sell this much. And, you can't really work it out. It's just a bit of a black hole, really.
Sure. Okay, on to a debut on the show.
Yes, Aptitude Software. So this is a debut. It's a request from Paul Adal, who has been on the show for interviews, by the way, if you do want to go and listen to them. He was very good. So he asked us to cover it and said he's intrigued by the transition from a legacy product to a new product and would be interested to see if I've come across it at work, because it's to do with accounting software. So for anyone who's not familiar with Aptitude, which does include me, they are a specialist provider of powerful financial management software to large global businesses. So this will be why I've not come across it, because their customers tend to be large international businesses, which will be at like big four firms, whereas the customers I deal with will be owner-managed businesses, generally much smaller. So that's why I've not come across it. And they've said that their product takes data from complex systems, typically with unique and siloed data sources across multiple business entities, to create a unified view of finance. This allows their clients to increase their level of control and deliver financial insights to drive the performance of their business whilst achieving regulatory compliance for complex accounting standards. So it's basically accounting software, but for really big businesses. So they have come out with their full year results, and annualized recurring revenue was up 2% to 52 million. AI autonomous finance was up 12% to 17.1 million. Other software was down 4% to 29.8 million, and Assure was up 4% to 5.2 million. So overall, revenue was down 6% to 70 million, with recurring revenue up 2% as mentioned, and non-recurring revenue down 26% to 15.6 million. The recurring revenue proportion has increased from 71 to 78%. Adjusted operating profit is up 2% to 9.9 million. Statutory operating profit is up 8% to 5.7 million. Adjusted operating margin is up 1% to 14%. And the basic earnings per share is up 22% to 8.8p a share. In the operational highlights, they've said that they've expanded the pipeline and grown the Fynapse pipeline 15x in active opportunities and 10x in value since July 2023. So Fynapse is Aptitude Software's next-generation automated finance management platform designed to transform finance functions into AI-powered strategic and trusted value creators. So it's basically their new software that is using AI as part of its product offering. They've said that they've secured enterprise clients with 6 major Fynapse clients: T-Mobile, HCSC, KPMG, Inspired, One Digital, and Chubb, including 3 AAH migrations. And they're scaling partner-led sales. They've streamlined from 60 partners to 6 managed partners: Microsoft, Deloitte, EY, KPMG, Capgemini, HSO, which exceeded their initial 30% ARR partner source target. So this is quite important in terms of the future of the business, where they are moving more towards a partner-led model. So previously, they directly managed the implementation of their software for clients, whereas now those 6 partners that we mentioned, so Microsoft, Deloitte, EY, KPMG, Capgemini, and HSO, they will be dealing with that on their behalf, and Aptitude are actually just kind of dealing with the software side, and it allows them to focus on the higher margin software as a service products, whilst their partners can make money from dealing with the deployment and the integration. So they've also said that they've got good new business success across other products, with a large Australian bank taking the Aptitude Accounting Hub and several US organizations taking Aptitude Revenue Management. They've extended engagement with 21 clients in 2024, taking expanded offerings and reinforcing stronger client relationships, and all the clients with the potential for future finance adoption. The board has decided to accelerate the transition from being dependent on in-house implementation to a partner-led model, which they expect will in due course result in partners delivering and implementing services. While this will impact short-term revenue, it's a necessary step towards a higher margin, better quality, annualized recurring revenue model. As a result, 2025 revenue and profits are expected to remain similar to 2024 before returning to growth in 2026. And they've said in the outlook, in 2025, they're accelerating execution, moving to the partner-led model, and whilst it'll impact short-term services revenue, over time it will increase profitability, increase revenue predictability, and align us to achieve 88% of annualized recurring revenue through those partners by 2027. If you look at the business over the past 5 years, earnings per share pretty much flat. It's actually moved around quite a bit, but overall it's not really changed significantly. Operating margin has decreased from 14.23 to 8.1%. Revenue's up from 57 to 70 million in that time frame. Free cash flows decreased, although if they're having to invest in these new products, that would probably be why. So it just looks like a business that over the past 5 years has been stodgy, but is with the caveat that you do have this potential transition to, firstly, the partner-led model, but secondly, the new AI-powered software. In terms of the valuation, it trades at a market cap of 144 million and has a PE ratio of 20. I think if they can move to the partner-led model, or if Synapse does really well, I think at that PE it's probably pretty reasonable, because you would expect that it's going to be a very high margin business. I think what I struggle with is, where is the growth after the transition to the partner-led model? Because at a PE of 20, you need something else. I think that's probably Synapse, but I would just be inherently uncomfortable. It'd be easier if I'd worked in a big four firm and I'd used the products, I guess, but I would be inherently uncomfortable with pinning my hopes on a product that seems to be talking about how it's using AI, just because there's so much buzz around it. I feel like you have to take it with a pinch of salt. But I think on the surface, it looks like a business where going forward, it probably looks better than it does looking backwards. And I think the direction they're heading in, I think, is probably the correct one. I think the valuation is reasonable if they do this and it works, but at a PE of 20, I wouldn't be fully comfortable with it, having never used or experienced the product. What about you, John?
Yeah, as someone who's even further removed from the product, I certainly wouldn't be comfortable with it. I think, as you say, the last 5 years have been pretty underwhelming. It is interesting with some of the partnerships that they already have, and I guess the prospect for, well, the recurring revenue there, but also, as you say, some of those new growth opportunities. Again, I think lacking the industry knowledge, I just wouldn't be comfortable at the moment going further with it.
Should we move on to a business then that's much easier to understand?
Absolutely. Probably, up there with Fevertree, I think, in terms of businesses this week. So it's G Barr. It's a company that we've covered many times before. It's a soft drinks and cocktail maker with brands including Iron Brew, Funkin' Cocktails, Boost Energy and Coffee Drinks, MoMA Oat Milk, Rubicon, Snapple, Tizer, and it's got a few others in that kind of category. They had their full year results out. Revenue was up 5.1% to £20.4 million. Adjusted operating margin, 13.6%, increase of 130 basis points. Adjusted profit before tax, up 15.8% to £58.5 million. And profit before tax, £53.2 million, which was up 3.7%. And net cash at the bank, £63.9 million, up 19.2%. and the group highlighting the soft drinks portfolio delivering strong volume and revenue growth, with standout performance from the Rubicon brand, which saw double-digit revenue growth, and pointing out they continue to invest in their supply chain to expand capacity and increase in-house manufacturing to support their growth plans. The multi-year capital investment programme at the Colbonault site progressed as planned, and in Q4 the board approved the initial phases of the next significant step in expanding the Milton Keynes site, which will further increase capability and capacity over the next 3 to 5 years. They also commented that they successfully progressed their strategic programme to strengthen the convenience channel route to market and integrate Boost into their bar soft drinks business. Both projects completed during the year and are delivering initial positive results. The business is in excellent financial health with strong cash generation and a robust balance sheet and improved return on capital. And the performance has been driven by an outstanding team who, they say, worked very hard with dedication, and that's been pivotal in executing the strategy. If we break the results down a little bit more, they do comment on the general soft drinks market, and during the period, value growth of the total UK soft drinks market was 2.6%, down from 8.3% in the prior year when higher inflation was prevalent. Both price and volume contributed to growth, although volume was constrained by the poor summer weather, which negatively impacted on the market during the key June to August trading period. Within the soft drinks market, the energy category continued to outperform the wider market, increasing 5.5% year on year in value terms. Cocktail market, the ready-to-drink alcohol market grew by 7% over the past 12 months and is now valued at £226 million. And that had been the main driver in the growth with the ready-to-drink, and Funkin remaining as the number one ready-to-drink cocktail brand in the growing sector. Plant-based milk, that remained relatively flat year on year, total worth £511 million. Volumes declined overall by 2.5%, and oat was the only segment of the plant-based drinks category to deliver volume growth 1.3%, supporting a value increase of 3.3% in the category. They do also go on to comment on how they're developing the brands and going on to some of the specifics with their soft drinks. So revenue was up 6.4%, gross profit up 7.6%, and volumes within that up 4.6%. And the three core drink brands being Iron Brew, Rubicon and Boost contributing 66% of the total business revenue, and revenue increasing by 8.4% on the year. Cocktail Solutions, revenue was actually down 6.1% and gross profit down 3.9%. Other, so revenue was up 7.6% and gross profit 12.5%. And this is consisting primarily of the oats drinks and the porridge since they acquired Moma in 2022, and continue to grow market share, now represents 57% of the plant-based milk market. And Moma grew the share of this category, driven by distribution gains within hospitality and specialty coffee. And gross margin came in at 39.1%, was as predicted up versus the prior year, which is 38.6%. So in terms of valuation, the group trades at, or has a market cap of £727.5 million and trades at 14.6 times earnings, with a prospective dividend yield of 2.6%. I thought these results were pretty good. I thought it was a bit disappointing in terms of the Funkin cocktails, and that's something I think that we've got used to performing pretty strongly. I know when we'd first covered the business, we were unsure about the Moma acquisition, but that seems to be well on trend and a pretty smart acquisition, although they did have to pay up for it. I know, again, we'd been a bit negative about it when we first started covering it, which was around the time that it lost the deal with PepsiCo and Rockstar. And I think it would be fair to say that Britvic had always been our preferred brand or preferred company. Britvic is now gone, and I think from an AG Barr perspective, it does look like a very decent business, and I think management have been smart in terms of how they've transformed some of their current brands. When it comes to Iron Brew, they've expanded that into energy, and I wouldn't say it's completely made up for Rockstar, but it's done pretty well so far, and they've been innovative in that sense. And then, as I mentioned before with MoMA, I think that was a quality acquisition, and they've got considerable market share in what is a growing market. Valuation, I suppose it's certainly not huge for a business of the quality. I was looking, after the recent turbulence in the markets at PepsiCo, though, and yes, that's quite a bit more expensive, but it's 17.5 times forward earnings. It's got a yield of 3.8%. And I think if you were looking at AG Barr, you would have to probably put it up against something like PepsiCo. And I would wonder whether, because a fair few of those brands are pretty mature in the AG Barr portfolio, whether you wouldn't just pay up for PepsiCo and also get the snacks business included there. Or, I guess, depending, which part or which geographical spread you're looking for, something like Coca-Cola or HBC. And I think for me, those two companies would be reasons that I wouldn't go for AG Barr. Sam, what are your thoughts on these results and AG Barr as a company?
Pretty similar. I think the results are decent. I agree the cocktails disappointing, especially when the ready-to-drink alcohol market was up 7%. Because I know they're still number one, but to me that suggests, they've not said it, but you can only assume from that their market share must have gone down. But I find it interesting as well that the overall plant-based milk market was down 2.5% in terms of volumes, because that seems to have been a bit of a turnaround actually in terms of the direction that's headed in. But I think they have historically done extremely well with the brands they've got. I think they've done extremely well at making smart acquisitions. And it's a company that has definitely grown on me. I think where I do like it, I think you can make an argument for it. And if someone had it, I think they could make a good argument. But it's similar to you. I think it's the opportunity cost. I think for me, I wouldn't, owning Fevertree already, I'm not looking and thinking, well, do you know what I really want? I want another drinks maker. And I just think they're broadly similar market caps. And I just think because of the US, Fevertree's probably got the better opportunity. That being said, I think we'd always talked about it. Well, not always, towards the end it had changed, but when Britvic used to be listed, we'd talk about AG Barr almost as an afterthought. And admittedly, because Britvic just has better brands, but when you actually look at the AG Barr performance in the time we've covered it, I think you have to give credit to them. They've done a very, very good job with what they have. But yeah, I think in terms of the opportunity cost, there's probably better companies out there, but I think they are a smart operator, and I'd feel pretty comfortable owning AG Barr in the portfolio. So yeah, I do like it, but yeah, I would agree with you. It is an opportunity cost issue.
Fine. Okay. On to our US company then.
Yes, so it's a Nike, which I'm sure is a company that needs no introduction. So Nike have come out with their Q3 results, and revenues were 11.3 billion, which were down 9% on a reported basis compared to the prior year, and 7% on a currency neutral basis. Nike brand revenue was down 9%. Nike direct revenue was down 12%. On a reported basis, and 10% on a currency neutral basis, primarily due to a 15% decrease in Nike brand digital and a 2% decrease in Nike owned stores. Wholesale revenues were 6.2 billion, down 7% on a reported basis and 4% on currency neutral. Converse was down 18% on reported, 16% currency neutral. Gross margin decreased 330 basis points to 41.5%. Primarily due to higher discounts, higher inventory obsolescence reserves, higher product costs and changes in channel mix, partially offset by restructuring charges in the prior year. Selling and admin expenses decreased 8% to 3.9 billion. However, the demand creation expense, which is another word for marketing, was up 8% to 1.1 billion, primarily due to an increase in brand marketing. So that's not good. They're marketing more and selling less. Overall overhead expense decreased 13% to 2.8 billion, primarily reflecting restructuring charges in the prior year and lower wage-related expenses. Net income was down 32% to 800 million, and diluted earnings per share were down 30% to 54 cents a share. Inventories were down 2% to 7.5 billion, and cash and equivalents were down 200 million to 10.4 billion. As cash generated from operations was more than offset by share repurchases, cash dividends, and capital expenditure. They've highlighted they continue to have a strong track record of consistently increasing returns to shareholders, including 23 consecutive years of increasing dividend payouts. In the third quarter, the company returned approximately $1.1 billion, including dividends of $594 million, up 6%, and repurchases of $499 million. Those repurchases, actually, if they're doing that a quarter, is starting to look a bit more meaningful because of what's happened to the share price. So if they're doing $500 million a quarter, that is on a market cap of $84 billion. So that would be a couple of billion a year. So it would actually be chipping away at it. As of February 28th, 2025, a total of 190 million shares were repurchased under the program for a total of $11.8 billion. So what have they returned in the third quarter? $1.1 billion to shareholders, which is more than their net income. So that isn't sustainable, unless this is just a wobble, which I would hope so. So I've mentioned as well, if we go through by geography, North America was down 8% to $4.8 billion. Europe, Middle East and Africa was down 10% to $2.8 billion. Greater China was down 10% to $1.7 billion. Asia Pacific and Latin America was down 3% to $1.47 billion. So they were down in every single geography. And if you look at the financials for the last 4 years, revenue's gone from 44 to 51 billion. Gross profit's gone from 20 to 23 billion. Operating profit, however, has gone down in that period, and the earnings are pretty broadly flat. In terms of the valuation, the business trades at a PE ratio of 17.76, has a dividend yield of 2.79%. In terms of the share price, it's worth mentioning as well, they've been badly affected by the recent tariff issues for obvious reasons. They are a business that would be severely hurt by tariffs, I think, given firstly how global they are, but secondly, a lot of the products are not necessarily made in the countries in which they're eventually sold, so that is a big problem for them. So in terms of the share price, so they're down 40% in the past 12 months, 37% over 5 years, and they're down from a high in 2021 of about $180 a share to $53 a share now. And the market cap is now 78 billion. So I'm pretty sure we've covered it when the market cap has been around 200 billion. Certainly well higher than that. So yeah, so these results are really bad. There's no getting around it. If you look at the company, it's kind of lost its way over the last few years. That being said, to get a business of Nike's quality for under 18 times earnings, yes, those earnings won't be there forever if they don't turn the business around. But I think they probably can. I think I've opened a position in this on the back of this, and that's probably not because of these results. It's probably more to do with the way the stock's been treated by the tariffs. My logic is these results are bad. There's no two ways about it. The company's kind of lost its way, but it's such a high quality business. It's one that, if you'd ask me at any point, would you like to own Nike in your portfolio? The answer would always be yes. It's one of the best brands in the world. And I think to get the opportunity to get it at 18 times earnings, I don't think there's going to be loads of opportunity for that. I think someone can come in and turn this business around. I think it is of a high enough quality. It's got some issues and it could take a while, but I think in 2 or 3 years' time, someone does come in and there is a turnaround. I think to have got it at this price, I think could be quite good. That being said, it's not going to be a huge position because what I don't like is that the results are bad. And this isn't just a business that's been battered by the tariffs for no reason. It's a business that has been battered, but also the business isn't performing as well. And you've got that double hit. I think that's why, it's down over 2/3 from its peak. I think how often are you going to get the chance to buy Nike at those kind of prices? So that's my logic with it. I'm not really making an argument based on these results because they're really bad, but I think someone can come in and turn this business around. What about you, John, as someone who's not biased?
Well, I think it's an incredibly high quality business, as you've said. It certainly looks, by historical standards, as fairly attractive valuation at the moment, but it is on the back of bad results and a very difficult macroeconomic situation for it. And it would be one of those companies that you'd expect to be very badly hit by the tariffs. So I don't know. I think if you're brave and Nike's been a quality, company that you've been watching for a while, it's certainly attractive at the moment. And it's always difficult to know how far things will go. But if they get a new chief executive, if things don't turn out to be as bad with the tariffs, it could well be, by historic standards, a pretty low price.
They've got a new CEO, actually. So Elliot Hill was appointed October 24. Previously, they'd had someone from Jan 20 to October 24, and then they've replaced him with Elliot Hill, who retired in 2020 and has now come back. And he started as an intern, actually, and worked his way up. So fingers crossed he's the man for the job. But the stock price was doing a lot better when he left. Let's say that. So of the 6 businesses then that we've covered this week, next, Gamma Communications, Fevertree, Aptitude Software, G Barr and Nike. Which you like the most and which you like the least?
I go for Nike, first choice, and it's not on the back of these results, but I think it's of the company and the quality that it's got there, and that it's at a more attractive valuation, by historic standards. In terms of what I like the least, it's difficult. I think both Gamma and Aptitude, I think Gamma, it again, seems like a good business, but not one that I understand. And Aptitude, I feel a lot further removed from it. And the results in the last few years haven't been particularly impressive. So probably Aptitude.
I think, without sounding boring, I think for me, Nike was the one I like the most, given that I bought it this week. So it'd be concerning if it wasn't. And in terms of what I like the least, I'd probably have to say Aptitude as well. I think I just struggle to visualize it. I think with Gamma, I've got the same issue, but with Gamma, it's because we've followed the business for a few years and I've previously owned it. At least I have some understanding and I know it's got that track record, whereas with Aptitude, it doesn't really have the track. You know what I mean? At least with Gamma, you can say, well, I don't understand what it does, but if they do what they've done for the last 10 years, it'll be fine. Whereas with Aptitude, it's like, well, I don't understand what it does, and I hope they don't do what they've done for the last 10 years.
Yeah, no, absolutely. Okay, well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.